1. PSU Bank stocks in focus, SBI, PNB, Union Bank rise amid merger rumors, should you buy? 2. India's new bank permits, driving economic growth. 3. Revolutionizing Indian banking, new norms for banks and NBFCs. 4. India's $30 trillion economy plan, banking reforms that could shock the world. 1. PSU Bank stocks in focus, SBI, PNB, Union Bank rise amid merger rumors, should you buy? Attention, investors! A potential game changer is brewing in the world of PSU banks, and we're here to break it down for you. The future of PSU bank stocks is at a crossroads, and the decisions made could impact your portfolio significantly. Let's dive right in. On Friday, PSU bank stocks were a mixed bag. While some, like Central Bank, Maharashtra Bank, and IOB, were trading in the red, others, such as PNB, Union Bank, and SBI, were showing signs of life. The Nifty PSU Bank Index felt the pressure, closing 0.07% lower. But here's where it gets interesting: a potential merger of PSU banks and an increase in foreign direct investment, FDI, are on the table, according to Bloomberg and CNBC TV18. The Indian government is reportedly considering building bigger and stronger banks, but there's no official confirmation yet. Good Returns couldn't independently verify the news, leaving us with a bit of a mystery. PSU bank stocks, a green light, Several PSU bank stocks, including PNB, Union Bank, and SBI, remained in the green during Friday's trading session. There was also a notable recovery in the movement of other PSU bank stocks during the last half hour of trading. Indian Bank and Canara Bank shares on NSE showed some positive signs. As of 3 p.m., SBI shares were trading 0.05% higher at 808.4 rupees per share on NSE. PNB shares were up 0.54% at 110.35 rupees per share, while Union Bank shares were trading at 144.01 rupees per share. The expert take, buy or hold, Antique Stock Brokerage has some recommendations for PSU bank stocks. They've given a buy rating to State Bank of India shares, with a target price of 955 rupees per share, indicating an 18% upside. Systematix Institutional Equities also recommends a buy for SBI, with a slightly higher target price of 1027 rupees per share. Union Bank of India shares received a similar buy rating from Antique Stock Brokerage, with a target price of 162 rupees per share, suggesting a 13% increase in valuation. Bank of Baroda shares were also given a buy rating, with an even more optimistic target price of 290 rupees per share, indicating a 21% upside. However, Antique Stock Brokerage recommends a hold for Punjab National Bank shares, indicating a 0% upside in the long term. Remember, this write-up is for informational purposes only. We haven't conducted fundamental or technical analysis, and we're not giving investment advice. Always consult a professional advisor before making any investment decisions. The story first appeared on Friday, July 11, 2025, and it's a developing narrative. Keep an eye on Good Returns for the latest updates. And this is the part most people miss: the potential impact of these decisions on the broader economy and your personal finances. Are we heading towards a new era of banking in India? Will these mergers strengthen our financial institutions? These are questions worth pondering. What's your take on the future of PSU banks? Do you agree with the expert recommendations? Let's discuss in the comments and share our thoughts on this evolving story. 2. India's new bank permits, driving economic growth. India is on the verge of a significant transformation in its banking sector, as authorities are considering the introduction of new banking licenses for the first time in a decade. This move aims to bolster the financial infrastructure necessary to support what is anticipated to be one of the most rapid economic growth trajectories in the world over the coming years. Officials from both the Finance Ministry and the Central Bank are engaged in discussions about various strategies to establish larger, more robust banks. One of the proposals includes allowing major corporations to apply for banking licenses, provided they adhere to restrictions on their ownership stakes. This could potentially open the door for innovative financial solutions and increased competition in the banking sector. Additionally, there is a push to encourage non-bank financial institutions to transition into full-fledged banks by obtaining complete banking licenses. This could enhance the diversity of financial services available to consumers and businesses alike. Furthermore, the discussions also encompass making it simpler for foreign investors to increase their investments in state-owned banks, which could lead to a more dynamic and competitive banking environment. But here's where it gets controversial. The idea of allowing large corporations to enter the banking sector raises questions about the potential risks of conflicts of interest and the concentration of financial power. Could this lead to a situation where the interests of a few overshadow the needs of the many? As these discussions unfold, it's essential to consider the implications of such changes. What do you think about the prospect of large companies entering the banking space? Do you believe this will lead to better financial services, or could it pose risks to the economy? Share your thoughts in the comments. 3. Revolutionizing Indian banking, new norms for banks and NBFCs. India's banking sector on the cusp of radical reform. Here's what you need to know. Buckle up, India's financial landscape is poised for seismic shifts. In a move that could redefine banking norms and unlock economic supercharged growth, officials from the Finance Ministry and the Reserve Bank of India, RBI, are hatching bold plans to reshape the sector. Imagine this: corporate giants sidestepping decades of restrictions to launch banks, non-bank finance companies, NBFCs, morphing into full-fledged lenders, and foreign investors getting unfettered access to stake a claim in state-run banks. These ambitious proposals aim to turbocharge credit flow and attract foreign capital, but not without sparking heated debates. The big picture. What's on the table? 1. Corporate giants may get banking licenses. Current discussions surprisingly propose allowing large conglomerates to apply for banking licenses, something the RBI outright banned in 2016 to prevent industrial houses from dominating the financial ecosystem. But here's the twist: any approval would come with strict guardrails. Think ownership caps and limits on managerial control to ensure the banks don't become corporate playthings. Why this matters: imagine Reliance or Tata launching a bank. That's the scale we're talking about. 2. Ease FDI limits in public sector banks. Right now, foreign investors can only hold 20% stakes in state-run banks, with government approval. But under new proposals, these caps might lift, opening floodgates for global capital injection. But wait, there's a catch. The government wants to retain majority control to maintain public oversight, especially in a country where banking penetration remains uneven. 3. Mergers and NBFC upgrades. Smaller banks might disappear through mergers, creating giants with broader reach. Meanwhile, NBFCs, especially those in southern India's booming contract manufacturing hubs, could convert into banks. Why southern India? Think Foxconn for Apple, a region ripe for financial infrastructure expansion. Allowing NBFCs to become banks could democratize credit access in these economic hotspots. Why this matters: India's banking woes. At present, India's banking sector is a global laggard. Only State Bank of India and HDFC Bank crack the top 100 global banks by assets. Compare that to the US and China, which dominate the rankings. Prime Minister Modi's vision of making India a developed nation by 2047 hinges on a banking system that can support a $30 trillion economy, one that requires credit to GDP ratios to nearly triple from 56% to 130%. Ominous? Maybe. But recent developments suggest this isn't just pie-in-the-sky thinking. The controversy: foreign investment versus public control. Critics argue loosening FDI caps risks ceding control to foreign entities. Supporters counter that without fresh capital, Indian banks can't compete globally. Take Japan's Sumitomo Mitsui Financial Group snapping up a 20% stake in Yes Bank for 13,500 Indian rupees crore as Exhibit A. Share markets already reacted positively. The nifty PSU bank index rebounded, signaling investor confidence. But here's the rub: how do you balance foreign investment with public interest? The road ahead. While talks are still in early stages, one thing is clear: India's banking sector is at an inflection point. Will these reforms create financial giants or open Pandora's box? Only time, and public debate, will tell. But one thing's certain: the coming years will determine if India's banks can become economic powerhouses or remain global also-rans. We want to hear from you. Should India prioritize foreign capital to boost its banking sector, even if it risks losing public control? Or should it double down on domestic solutions? The debate is yours to join. Comment below with your take, and let's keep the conversation going. 4. India's $30 trillion economy plan, banking reforms that could shock the world. India's ambitious vision of reaching a $30 trillion economy by 2047 could fundamentally alter the landscape of global banking. This is not just a dream, it's a potential reality that hinges on significant changes in the country's banking regulations. Recent discussions among Indian regulators, particularly within the Finance Ministry and the Reserve Bank of India, suggest a willingness to revisit the banking framework. They are considering allowing large corporations to reapply for banking licenses, albeit with stringent control measures, promoting non-bank financial institutions to transition into full-service banks, and easing restrictions on foreign ownership in state-owned banks. Although these conversations are still in their infancy and no specific timeline has been established, the implications of such reforms could represent one of the most transformative shifts in India's financial system in the last decade. So, why is this happening now? The answer lies in the urgent need for increased credit and larger banking institutions to meet India's growth aspirations. Currently, bank lending constitutes only 56% of the nation's GDP. To achieve Prime Minister Modi's ambitious target of a $30 trillion GDP by 2047, this percentage must soar to approximately 130%. This necessitates a significant enhancement of India's banking capabilities, particularly in manufacturing-centric regions like southern India, where major global companies, including Apple, are establishing operations. At present, only two Indian banks, the State Bank of India and HDFC Bank, are ranked among the top 100 banks globally by assets, while countries like China and the United States dominate the upper echelons of this list. Notably, India has not issued a new full banking license in nearly 10 years, and since 2016, conglomerates have been prohibited from owning banks. Interestingly, there is already a growing interest from investors in this evolving landscape. For instance, in May, Sumitomo Mitsui's banking division made headlines by acquiring a 20% stake in Yes Bank for $1.58 billion, marking the largest foreign investment in India's banking sector to date. Following the news of potential reforms, the Nifty PSU Bank Index, which tracks public sector banks, rebounded, gaining 0.5%. While the future of these proposals remains uncertain, one thing is clear: India recognizes that it cannot achieve its $30 trillion economic goal with outdated banking practices. If these proposed changes are enacted, they could unleash a wave of long-term investment and significantly reshape the financial environment, making it a focal point for investors to monitor closely. But here's where it gets controversial: are these reforms enough to truly transform India's banking sector, or are they merely a band-aid solution? What do you think? Could these changes lead to a more robust financial system, or do you believe they might introduce new challenges? Share your thoughts in the comments.